Hello, everybody. As you can see, I'm still a little bit in the vacation attire here. We are having a very warm summer in Denmark, but I am back from my vacation and I thought I would give you a little bit of an update on what's going on in the markets, but also a little bit on what we are working at Markets and Money Advisory. And let's kick it off from there and follow up with some more videos in the coming days. But first, to the markets. It seems like the emerging market sell-off that we have seen over the last couple of months to a large extent is continuing. It is changing in terms of what is driving it, but we are still seeing significant pressures on certain emerging markets. Obviously, mostly the Turkish story has been in the attention of investors. We've seen the lira continuing to be under pressure. We also seen Turkish stock markets under pressure. Turkish 10-year yields is approaching 20%. So no doubt we are seeing a significant pressure on Turkey. And then actually overnight we have seen Russian markets come under pressure as well, after it has been announced that the US government is implementing new sanctions against Russia in response to the chemical attack in Britain a couple of months ago. It's a somewhat late development or late action from the US government, but nonetheless, it seems like the Trump administration is now, for some reason, being pushed into implementing new sanctions against Russia, and we can see that in the Russian markets. So let's talk about both Russia and Turkey. I fundamentally think that the overall emerging market, the sell-off we have seen this year, is a combination of two things. It's a combination of, on the one hand, the tightening of global liquidity, primarily driven by the fact that the Fed has continued to quote unquote normalize its balance sheet, essentially reduce the money base, and at the same time hike interest rates. And of course, we've also since April seen a general strengthening of the dollar. We have also seen some pressure on the Chinese renminbi. I think that's to some extent is a separate story, but that probably also reflects the tightening of global liquidity has put pressure on the renminbi. But I don't want to overstate that story. But the general picture of a tighter global liquidity certainly is there. We can also see that if we look at markets, the flattening of the US yield curve, the strong strengthening of the dollar, some widening of credit spreads, etc. So generally the picture is one of tighter global liquidities, and that's what the markets have been telling us for some time. So that's one part of the story. The other part of the story is the local stories. And the local stories is essentially also split into two. First of all, fiscal worries. We've seen that in Argentina, most clearly, obviously, but also I believe it plays a much bigger role in the sell-off in the Turkish markets than most commentators really makes clear. Why is that? Well, since Erdogan's party, AKP, came into power in 2002 and 2003, essentially public finances have been developing positively in Turkey. We have seen a dramatic decline in public debt in Turkey. The budget situation has improved. So one of Erdogan's trademarks have been that he has been fiscally conservative, a fiscal reformer in many ways. If you look over the entire period since 2002, 2003, it has been one of fiscal consolidation, significant fiscal consolidation in Turkey. However, I also believe that what we have seen in the last couple of years is a reflection of a political business cycle. The fact that the Turkish government has moved to ease fiscal policy because it needed to win a number of elections in recent years. Recently, of course, both a parliament election and a president elections. And it's a little bit of an untold story that the primary deficit in Turkey has actually increased, and it is most certainly our calculation of what is the threshold level of what kind of yields is now the level by which we will see Turkish debt levels explode has been moving downwards, meaning that the cushion has become smaller, and that is a result of the underlying worsening of Turkish public finances due to more expansionary fiscal policies in recent years. We see the threshold levels on Turkish debt around 13%, meaning that if 5 to 10-year bond yields in Turkey are above those levels, Turkish public debt will grow a share of GDP, and that of course is with yields approaching 20%, already above 20% in the short end of the curve. As we already seeing that, we essentially seeing unsustainable public finance developments, and I think that's really a key story. And therefore, to see a stabilization of the situation in Turkey, I think is very key that the Turkish government move to implement fiscal austerity, and they do it in a bold fashion upfront. So it's credible. So investors can be convinced that actually, finally, the Turkish government is doing something about this crawling or this emerging public finance problem. If we look at Russia, there we actually have seen a bit of the same thing. Russia have seen its public finances under pressure in recent years due to falling oil prices. However, I would stress that actually in terms of Russia, oil prices measured in ruble has been going up because the ruble has been weakening. And that, of course, one of the reasons why the ruble is weakening is that oil prices are down, and to stabilize public finances, the Russian government in that sense do not mind a weaker ruble as it stabilizes revenues in local currency. And we're also seeing that now, despite of the situation, oil prices measured in ruble is continue to rise, and that is helping public finances in Russia. Another thing that is helping public finances in Russia is the pension reforms which was implemented during the World Cup in football recently, where the pension age for women and men was increased rather substantially. And I think that was clearly a right move on part of the Russian government. So if I look at Russia versus Turkey, I think the public finance situation is much less alarming in Russia than it is in Turkey. And therefore, I'm less concerned about Russia from that perspective. But the other thing that goes on both in Russia and Turkey is, of course, both geopolitics and domestic politics. If we look at Turkey, it is very clear that President Erdogan and his government is certainly not as popular as it used to be. And it's very clear that as inflation accelerates, now just inching up towards in the coming months, probably 18-20% inflation, then obviously that is not something that would make Erdogan more popular. So there is an element of the de facto authoritarian leader in charge becoming less popular. And interestingly enough, if you look at Russia, that's the same story. Recent opinion polls shows that even though President Putin's overall approval rating is high, I think around 65% in a recent opinion poll, it has been declining quite a lot in recent months. So I think both Erdogan and Putin are under pressure in terms of their domestic approval ratings. They're not as popular as they used to be. And the international situation with tightening global liquidity, it's making it much harder for them to navigate. And they need to tighten fiscal policy, and that's not going to be popular. So really, both Putin and Erdogan are facing some of the biggest headwinds they essentially have done since they came to power in the early 2000s. From the economic perspective, and of course that could lead them to take more unorthodox economic measures. So far, Putin has stayed on a straight line. We have seen that the response to the problems have been to tighten fiscal policy, implement pension reform, all very, very good from an investor perspective. In Turkey, however, it seems like President Erdogan has lost it in terms of economic policy. When he came into power in 2002, 2003, the AKP government implemented very orthodox economic reforms, slashed public spending, public sector reforms, privatizations, our independent central bank with an inflation target, and all of these things that was eventually the recommendation of the so-called Washington Consensus. Washington Consensus policies were implemented and investors loved it. Putin seemed to stick to the Washington Consensus to a large part still, but Erdogan has been losing it. Recently, of course, appointing his son-in-law as finance minister, a guy who has little credentials to be finance minister. I actually noticed yesterday former Minister of Economics in Turkey, Mehmet Şimşek, out and highlighting that tightening global liquidity could put pressure on emerging markets. And I'm wondering what emerging markets was he talking about. It was pretty clear to me that was probably Şimşek's first comments in terms of raising some concerns about the situation in Turkey that could be contrary to what is the political interest of the government. So that was rather interesting. So Turkey and Russia very much still in focus. I'm less concerned about Russia on a fundamental level than I am on Turkey, because I'm not entirely sure that Erdogan will do the right thing. And let's talk about a little bit about some Turkish scenario. One scenario is, of course, that Erdogan and his government do not understand that there is a need to tighten fiscal policy significantly to signal to markets that they're serious about this. Another thing is that there needs to be a very strong commitment on part of the Turkish government to the central bank's independence. And to do that, you would likely also have to accept that the Turkish central bank will hike rates even more aggressively. And we've seen it recently. The Turkish government has been behind the curve relative to market expectations in terms of hiking rates. You can ask yourself whether it's the right thing to hike interest rates. But if you have a central bank which is controlling interest rates, use interest rates as primary policy instrument, as is the case in Turkey, you should move your interest rates with what we call R star, with the natural rate of the interest rate. And if for some reason the risk premium on a certain country goes up, the natural interest rate will go up as well. And judging from the development in Turkish CDSs and in Turkish markets in general, it's very clear that the risk premium on Turkish assets have gone up dramatically. So interest rates have to reflect that, otherwise monetary policy becomes excessively inflationary. And that's of course what we can see now in Turkish inflation expectations. So yes, the Turkish central bank need to hike rates rather dramatically to reflect the increase in rising risk premium. Not to stabilize the currency, but to reflect the rise in the risk increase in the risk premium. But there is also a problem here. There is essentially some unpleasant monetary risk parametrics at play. With public finances being unsustainable, with a Turkish government that hasn't really significantly signaled that they want to do something about that, market participants will have to consider what happens to monetary policy. One way of stabilizing monetary policy is, of course, to have higher nominal GDP growth. You can get higher nominal GDP growth by having higher inflation. You can have higher inflation by having a currency that plummets. So that also means that as long as fiscal policy is not sustainable, it's very hard to have an independent monetary policy. The extreme examples of this is, of course, Argentina over the past decade, or most clearly what we are seeing in Venezuela, where inflation is probably well above 1,000,000% and likely closer to 2 or 3 million% at the moment. And that's of course a reflection of huge fiscal imbalances that both spurs expectational channel and actual printing of money to finance the Venezuelan government. We're not seeing that in Turkey yet, but obviously it seems like if you're listening to the rhetoric of Tayyip Erdogan, then President Erdogan's rhetoric increasingly sounds like something we hear out of Caracas rather than something we would hear out of Frankfurt. And therefore, there is pretty good reason to be concerned about investors. Therefore, is it time to get into the Turkish markets? And my answer would be no. Because yes, the Turkish lira is significantly undervalued, probably on a purchasing power basis, 20 to 30% undervalued at the present moment. And therefore, there is a great chance of making money in the Turkish markets once we have a recovery of some kind. But that is not yet. What triggers would I look at? Well, the first thing is the global monetary situation. We need to see some kind of change in the continued tightening of global monetary conditions. That's a little hard to see now because the US economy is doing great. Growth is strong, unemployment is low, and inflation seems essentially to be pretty much well anchored around 2%. So the Fed is likely to continue to hike rates. Whether it'll continue to do it all through 2019, I doubt, but there is a risk that the Fed would move in that direction, and clearly then you get to a situation where the yield curve might even turn negative sometime in 2019. That would just be hell for emerging markets. And so we need to see some kind of markets catching up with the Fed or the Fed slowing down to markets. So at that point we see the outlook for global monetary conditions moving in a more easy rather than more tight direction, and that would be helpful for emerging markets, particularly those with fiscal problems as large current account deficits, as Turkey is the situation has. So we need to on that. That would be the other trigger. I would like to see a firm hand on fiscal policy in Turkey, a clear fiscal tightening being announced by the Turkish government in a way that is 100% credible. That can also be very hard, and as part of that, guaranteeing the central bank's independence. We could also see in kind of Turkey that could go hand in hand with the change of guard, a new central bank governor, and a new minister of finance. I recently on Twitter half joked that former central bank governor Yilmaz should be reappointed, and former minister of finance Kemal Davis should be reappointed. Of course, this is like 17 years ago he was finance minister, but doing that, and that's not going to happen, but that would be a signal to the markets that the Turkish government was serious about fiscal reform, fiscal consolidation, and the independence of the central bank. But that's kind of thing we need to move in direction of. So are we going to get that? Well, I'm very doubtful of that. We're probably going to muddle through. Erdogan understands this, and Erdogan at some point always makes a turnaround. But I have a hard time seeing that turnaround right now. And that brings me to the very last thing, and that is, what are we working on? Because to be quite frank, I haven't had as much vacation as probably my family would have liked to have seen. We have been working in the last couple of months on our asset allocation project. I can't say too much about that, but hopefully that leads to some interesting product developments from Markets and Money Advisory. But what we've been working on is looking at developing a global monetary indicator, which can be used as a trading tool. Obviously, in our global monetary conditions monitor, we have a number of monetary indicators, and that has inspired us to develop something that we can use as trading signals. Something that can tell us when investors should be invested, for example, in emerging markets, or be short the global equity markets, or buy credit bonds, and so forth. Because it's very clear that what we could call monetary momentum, whether global liquidity is becoming easier or tighter, is extremely important to the relative performance of different asset classes. And we've done some work on it. And well, we've done a lot of work on it. And we have essentially developed a global liquidity indicator. And over the summer, we have been working on backtracking, backtesting this liquidity indicator to see whether we can use that as a trading tool. And what we have done is that we have tested on different markets. We have tested on equity markets, we tested on bond markets, we tested on commodity markets, we tested on emerging markets, we tested on FX markets. And what our backtest shows is that we have now developed a global liquidity indicator, which can add to performance for investors. What we have shown is that a global liquidity indicator is a good indicator to be used, for example, to decide whether you want to be invested in emerging markets or whether you want to be on the sidelines, whether you want to be long the stock markets or whether you want to be long the bond market, whether you want to buy risky assets while you buy safe assets. And so what is the global liquidity indicator telling us right now? Well, I already told you, global liquidity is tightening and our indicator is saying that. And based on that, the signal from that is, well, stay clear of risk. That would mean be on the sideline in terms of global stock markets. Be particularly on the sideline in terms of emerging markets. Look for more downside risk on commodities. Look for dollar strength. Look for weakness in emerging market currencies. All of these things is essentially something we have back tested, and as long as liquidity continues to tighten globally, those are the trades you want to have on. I hope to be able to share a lot more on our work on this going forward. We'll be sharing it with clients once we have more. But I'm very interested in your input on how that can be used in your trading process, in your investment process, and let's see what that brings us. And thank you very much, and have a good day.